Now imagine you have taken a bear call spread on Nifty. You were bearish on the market and the market was going down too. But suddenly the market started rising, and as it started rising and then it started even sprinting. What do? Do you exit in panic or do you adjust like a pro? Hi, I am Pranav VK, your options trading strategist here at Stockshala by Kotak Securities. In the previous video, we learned how to adjust a bull call spread if things go wrong. And in this video, instead of a bull put spread, now we are going to take a bear call spread and see what adjustments can be done. Let's do a quick recap of what is a bear call spread. Imagine Nifty is at 25,000 and you're bearish on Nifty. So what you're going to do is you're going to sell a 25,600 call option at a premium of, let's say, 80 rupees, and you're going to buy a 25,800 call option at, let's say, 40 rupees. So here you're gaining 80 rupees, here you're paying 40 rupees. So the net credit in this case is 40 rupees, and this is a bear call spread. So if Nifty starts going down from 25,000 or stays in and around that region, then there is no problem. The problem arises when it has to start going up and if it goes sharply in the opposite direction, and that is when we will require an adjustment. So I'm going to share 3 different adjustments that you can do for a bear call spread. So the first adjustment is rolling up and widening the spread. The second one is converting a bear call spread into an Iron Condor. And the third one is adding an additional hedge for more protection. So let's start with the first adjustment. Imagine 25,000 starts inching towards 25,500. Then what are you going to do? What you can do is very simple. You can exit these 2 positions and roll over to a higher position. So we can go from 25,600 to 25,800. So you're going to sell a 25,800 call option, and then you're going to buy probably 26,000 call option. So this way you're going to shift the break even from a lower point to a higher point, so that gives you more breathing room. So use that adjustment when you feel that the market is still going to be bearish, but you saw an upward movement just because of news or a breakout. Now let's go to the second adjustment, converting the bear call spread into an Iron Condor. When it comes to the bear call spread, we know that the payoff diagram looks something like this. And what we can do is we can add a bull put spread to convert this into a complete Iron Condor. So how do we do that? So we already have a bear call spread. All we have to do is add a bull put spread. So since Nifty is at 25,000 and we expect the market to be flat or moving around in that range, what we can do is we can go for a 24,500 put option sell and a 24,000 put option buy. Again, these strikes could be a little bit more nearer as well. Depending on the values of the market and volatility, you can decide these strikes. So once you have done this, now we have a complete Iron Condor. So your probability of having maximum profits is going to increase. Going ahead with the third adjustment, let's say you want to retain this entire structure and you're still bearish on the market. So what are you going to do? You can simply add another additional hedge. So along with 25,800 CE, you could also add 25,900 call option. So this way, you're adding an additional hedge and reducing the maximum loss possibility while still retaining the entire structure. Do this adjustment only if you believe that the market is really going to stay down. Now, as a bonus, let me give you another adjustment technique. Bonus number 1. You can shift your strikes from the present expiry to the next expiry, just like how we did in the bull put spread. So that way, you're going to get a higher credit and most importantly, more time for the market to recover to your levels. Bonus number 2, you could also convert this bear call spread into a call ratio spread. That way, you're going to get more profits as well as bandwidth for your losses. So how do you convert a bear call spread into a call ratio spread? Very, very simple. Here we have a single sell of 25,600 as well as a single buy of 25,800 CE. All you have to do is make sure you're going to add another position of 25,600 CE. So that way you have 25,600 CE into 2 and you have one buy position. So that way your bear call spread is going to now get converted into a call ratio spread where you're going to have higher bandwidth and also going to cover for the losses in your trading. But let's say IV is increasing, there is a confirmed breakout along with volumes and the shift in structure in the price action. Then the best adjustment that you can do is no adjustment. In those scenarios, close the trade, book the losses and wait for next opportunity. So let's summarize what we have learned so far. We did a quick recap of what is a bear call spread. We know that it is nothing but selling out of the money call option and buying farther out of the money call option. We also learned that there are different kinds of adjustments that we can do. The first one was basically rolling over to higher strikes so that the break even can shift from a lower level to a higher level. The second adjustment was converting the bear call spread into an Iron Condor by adding a bull put spread. The third adjustment was basically adding an additional hedge so that the maximum loss can be reduced while retaining the overall structure of the trade. And finally, we also learned that we can convert the bear call spread into a call ratio spread so that your losses can be overcome. And the bonus number 2 was we can also shift the strikes from present expiry to the upcoming next expiry so that you can receive a higher credit and as well as enough time to recover. Remember that a bear call spread can feel like a trap in a trending market, but if you know how to adjust, then you can pivot smartly. You're watching Stock Shala by Kotak Securities. Don't forget to like, share and subscribe. I'm Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.